Across the world, governments are missing out on billions of dollars, euros, yens, pounds, yen and other currencies of tax revenues. In the EU alone, I recently estimated that the annual loss of tax revenues as a result of illegal tax evasion is 825 billion euros a year, and tax avoidance might add another 150 billion euros or more to that. That is almost €1 trillion. In many countries, the loss is bigger than the health budget. This is a big issue. So the question is, what can be done about it? One answer is that governments need to measure tax gaps. These are the gaps between what our governments expect to receive in tax revenues and what they actually get. Very few governments do that. And that means that they are not even acknowledging that they have a tax collection problem. The first step in solving any problem is recognizing there is one. But then governments need a plan. That's where what we call tax spillovers come in. Tax spillovers are the flaws that exist within and between tax systems that mean that the system actually undermines itself, so making it easier for those who cheat to get away with their crimes. For example, if a country has a top income tax rate of 45% and a top corporation tax rate on companies of 20%, it's fairly obvious that top income tax earners are going to try to shift their income into companies. This creates a tax spillover by encouraging tax avoidance. And if a government does not invest in enough staff to chase tax cheaters, they're going to get away with their tax evasion. That also creates a tax spillover. Alternatively, if, as is, for example, the case in the UK, there's a really lax company administration system that means it's really easy to dissolve companies without questions being asked, then the opportunity for people to simply evade all their tax obligations is created by a failure to put the proper law in place. And that has massive tax spillover consequences within the country and beyond it. Whilst if tax havens can provide secrecy so that money can be hidden offshore, then they, in this case deliberately, undermine a domestic tax system. That too creates a tax spillover. We need to do something about these issues. What we need is a system for assessing these tax spillovers. Where do they happen? How do they happen? And how do we stop them? Vitally, how can we change the tax system from one where it seems there is a perpetual race to the bottom caused by tax competition to one where nationally and internationally taxes are designed to be mutually supportive so that governments can fairly and appropriately raise the revenues that they need from those who should pay them? Professor Andrew Baker of Sheffield University and I have developed a system to answer these questions by identifying tax spillovers. It marks spillover risk on a scale from 1 to 5, and it considers 64 different kinds of risks in total. And it does this 3 times. Once is to identify tax spillover risk within a country's own tax system. Then the risk it faces from other countries is appraised. And because few countries are complete paragons of virtue, the deliberate or inadvertent tax spillover risk that a country creates for other places is appraised as well. And what this means is that over time a country will know how to best tackle the tax collection problems it faces. And that might mean it has more tax revenue as a result. Or it could instead mean that it could reduce the tax bills for honest taxpayers because the cheats will now be paying. So we might have better services or more money in our pockets, or both. What's not to like about tax spillover assessments? It's time to do them. My name is Richard Murphy and I work for the EU-funded Horizon 2020 project, COFFERS, which is about combating fiscal fraud and empowering regulators.